hungry. I need my food.
And, well, hopefully this webinar will cure your hangriness, or you can, leverage that hangriness to do a good job on this webinar. I think we're live. Ladies and gentlemen,
whoa!
Thank you so much for tuning in to the Block Presents Institutional Spot Liquidity, brought to you by Altonomy. We're very excited for today's session. We have folks from across the landscape, and we're going to talk about probably the most important thing, right? I mean, this is one of the most important things when you think about trading is liquidity. And I guess before we dive into it, I think it might be worthwhile to have each of the panelists sort of introduce themselves, tell us a little bit about what you guys do, because you do sit in different corners of the market. And I know Meltem, CoinShares is a lot different from where it was maybe a year or 2 years ago. So I'm Frank Chaparro, the Director of News. I guess we'll kick things off to you, Meltem, Chief Strategy Officer at CoinShares, and then we can go around the table, so to speak.
Yeah, for sure. Thanks, Frank. Meltem Demirors here. I am with CoinShares. We are a digital asset investment firm. We have three core components of our business: asset management. We have publicly listed product in the European market. We just crossed $1 billion in assets under management there last week, which is a great milestone for us, and I think for the overall industry to see so much interest in ETPs. And I know here in the US, there are other products that have also been just growing exponentially. We have a capital markets desk. We're trading on average 2 to 3 billion notional every quarter across a number of different venues, but really focused on creating a liquidity layer and electronic access to liquidity. And we can definitely talk about that and what that means. And then I'm focused on the active strategies and advisory side. So we have a venture strategy. We've had active funds in the past and are now also working on the credit side of the market. So we cover a wide range of activities. We're New York, London, Jersey, Channel Islands, and then we have a few folks scattered around the globe since this is a 24/7 market.
Awesome.
That's it.
Oh, me?
Yeah, go right ahead.
Oh, cool. Thank you, Frank. Hi, everyone. This is Ricky Lee, co-founder of Altonomy. Some of you guys have probably already heard us. We've been around since early 2018. Most of the stuff we do actually have a few components of the business. One is actually our OTC trading and liquidity providing, where we work with probably all the major VCs, family offices, hedge funds to help them to access liquidity. And not only just Bitcoin and Ethereum, but also in the long tail altcoins tokens market as well. In the meantime, we also have our own proprietary mining business that actually span across China and the US. That we help manage some of their own miners' assets as well as some of the clients' assets as well. In the meantime, right, we also have our own sort of like a proprietary trading arm that actually comprises of guys from traditional finance that actually building quantitative models to profit from the market. In the meantime, if you see some interesting projects that actually have synergies with us, we will also do a little bit of venture investing as well. So, those are three business lines we majorly run. Currently, New York, Singapore, major offices, and also we got a set offices in Shenzhen and Shanghai.
Dan, I think your business might be the most straightforward, right? Just hunting shit coins all day long.
It's basically, yeah, which is a great business to be in right now.
Yeah.
So CMS is a proprietary trading shop. We trade partner capital. There's three of us got started it up about a year ago now. We kind of trade anything from the way long tail of alts, all the way to the liquid stuff. Probably do about $20 to $25 million in notional a day. Most of that is heavily concentrated in the majors. And then we do full investing suite of like new issuance, tokens, DeFi, Uniswap, you name it. If the action's there, we try to get like a piece of it and move into it. But yeah, we got a pretty open mandate because it is all partner capital. Obviously, we all have pretty deep backgrounds in the industry before. Most recently did OTC trading at Circle, which is probably going to be most of my insight into the conversations today on the liquidity providing.
Mm-hmm. All right, well, let's dive into it. Full disclosure, the air conditioning at the block is broken. So if I start profusely sweating during the course of this, raucous conversation, please forgive me for that perspiration. I guess.
Wait, Frank, don't lie. It's the gabagool. You have the gabagool sweats.
See, that's where we're, you know, the combination of both really is, the odds are not in my favor. It is a lot. So let's start with a question that when we were talking on the prep call earlier this week, when we were all, you know, trying to figure out how we'd navigate this thing. The question about like how liquidity has moved, right? If you think back on 2017, it was really centered in the sort of OTC trading market with like large firms like Circle Trade and DRW sitting at the center of this market's liquidity. And Dan brought up a good point during the call, which was in a lot of cases when folks wanted to move size, you know, the exchanges were either out or there was, you know, slippage and not really a reliable trading experience for them. So I guess the first question, and we'll start with Dan, how has that changed? You know, because my sense is it's not necessarily, you know, it's definitely not centered on those desks anymore, but has it moved maybe out of the OTC market? Has it moved out of spot? Where do we see liquidity centered?
Yeah, so the liquidity, it depends on what you're talking about, but the majors, right? Like Bitcoin, ETH, it's very much gone to the derivatives and it's very much gone on screens, right? So like there's a bunch of things that sort of push that. Definitely BitMEX getting really big in the back, like wake of the 2017 mania, really helped shore up the liquidity on the screens. And then you also had like an influx of all like the traditional Chicago guys, right? Like your Jumps, your Hudson River Tradings, your like DRW's electronic arm too. They all got into it. You had like the existing shops that got bigger, such as like Alameda, B2C2. Like, so anyway, like the electronic liquidity got really good when the futures got really liquid. CME helped that. Like that helped a lot of guys like peel in, and then like, so that deep liquidity on the futures side just translates into the spot side, right? Because like that risk can just get like hedged out between the two. So spot liquidity got really good for like the majors, specifically stuff that could get hedged on the futures. And that took a lot of the liquidity needs away from the OTC markets, or it just like drove like the spreads down, right? Like stuff just got super liquid. That being said, what you're seeing now is a lot of liquidity needs in like the longer tail of stuff where there's like either no derivative options, most likely, or there's not even good spot options, right? Like some of this stuff like only trades on Uniswap or like only trades on 2 no-name exchanges that you can't really get limits on. I mean, this like sort of feeds into like Ricky's business a lot. That stuff still remains traded bespoke. A lot of that happens like via OTC guys who are willing to warehouse risk. I mean, like the 2017 birth of the spot liquidity, and the reason it went OTC is it was really hard to onboard on exchanges, if not impossible, let alone get the limits you needed. And there was like really only a handful of guys that would like take real risk on it. And they just like sort of gobbled up like the needs at that like time in history. But anyway, it's just gotten efficient, like more, and it's also not as crazy. Like the pipes work a lot more. Like you can move real money around. Sen's probably doing trillions of dollars a year in like movement. Like it's just a much more efficient. You can put that sort of volume through it, which is like really helped. So anyway, it's just the evolution of markets, and like you're seeing the longer tail stuff now experiencing the pains that like you saw in the majors now currently.
Mm-hmm. Meltem, you guys are trading, you know, tens of millions of dollars a month, right? What are the major liquidity needs that you're seeing out there in the market right now?
Yeah, I mean, I think as Dan alluded to, you know, we've been on screen since day one because we had to market make for an exchange listed product. Like Interactive Brokers is not offering Bitcoin in 2015, right? Mm-hmm. So we built a lot of trading infrastructure, and I think definitely the move into derivatives volume, you know, last year, $3 trillion. This year, we're on pace to treble, if not quadruple that or more. That's grown a lot. And so, you know, there's highly liquid markets. We're investors in Paradigm, which is creating the ability to do block orders and do more complicated trades and put together different sort of like spreads and different legs of a trade more efficiently, do RFQ to a bunch of brokers all at once, so you're not having to do things manually by voice or by email, which I think has helped a lot. You know, I think where we're seeing the challenges around liquidity, number one, people have a fundamental misperception of what liquidity means. So I just want to address that really quickly. I think a lot of people think liquidity means being listed, and that's not at all what it means. As Dan alluded to, you know, liquidity is about the depth of the order book and being able to move in and out of position at a price nearer where you got in at. I think the challenge is today, unless you're looking at the volume traded assets, like one of the metrics we track a lot is how long would it take us to unwind a position based on the liquidity in the market? I think a lot of people who are like marking to market and looking at their book aren't necessarily thinking about the liquidity profile of the assets that they hold, particularly with this long tail of like Uniswap only traded assets or even new assets that are launching. In fact, just 10 minutes ago, we're just like going around the horn here on this chat. We're talking about new exchanges that are listing IOUs and new tokens lists, trying to create liquidity. The challenges in a lot of the long tail assets, there isn't market depth. So it's really hard to get indications of price at size. And so I think for us, what we're really focused on is what is that ecosystem going to look like? The other piece I want to bring up that I know we'll get into is access to leverage. If we, where the industry is moving, we're evolving away from the spot side of the business to more of a market driven by trade leverage. And so I think a lot of what you see in DeFi is people who are fundamentally long, just trying to get leverage on assets they already own, and trying to get leverage on their trade. So that's what we've been really interested in, is what is the leverage side going to look like? We spent a lot of time on different cross-margining solutions like X-Margin, which are attempting to, instead of creating these monolithic PBs, which is one approach, how do we create liquidity aggregators so that the price discovery and execution layer, the cross-margining layer, and then settlement layer, instead of depending on one institution and internalizing everything there, you can get trades where you want, with who you want, clear and margin how you want, and settle where you want. In my view, that's like really where the magic's starting to happen. So I'm pretty excited to shift away from the PB approach to more of a network-driven approach. And maybe, who knows, we'll get some hub and spoke players in there as well. I think there's certainly a few people who are trying to move that direction.
Well, we haven't even got any real PBs to come online yet, but it's interesting. We can talk about how that's maybe impacting market structure and liquidity. But I want to go to Ricky. If you think about like the fragmentation of this market, it's continuing to get more fragmented, more exchanges are coming online, more products. Jump-starting those markets and jump-starting those new trading venues has to present an opportunity for any liquidity provider, even if the ball's not there.
Yes, absolutely right. So actually, I echo what Dan mentioned about the liquidity profiles between the majors and the altcoins, right? And the majors definitely has already run its course of from spot futures, and then futures refeed the spot side liquidity, and now everybody's trading with the same spreads everywhere, right? Within a very small differences. But what I want to address is that in Altonomy's business is more on the retail, on the long tail side. That market is still very, I call it a wild west right now, because new tokens are issued every day, and we're seeing as the market heats up, new assets keeps hitting the market on the spot side, and for that, the places you can access liquidity is very limited, right? There are clearing exchanges that you cannot get an account, and there are Uniswap that you cannot actually punch a sizable order. And all of that actually presents opportunities for guys like us. It's like we actually connected everywhere, right? We help the clients basically source liquidities in whatever ways it needs. Sometimes even just bilateral, actually go directly to the core of the to the issuance party, which is normally the project teams as well, right? So, and one interesting example that I mentioned in the prep call is that like the YFI, right? The whole frenzy of issuance of YFI, right? In the first week is that everybody was looking at it. Everybody wants to buy it from and the only venue they can get it is actually either go to Andrew himself or just look at it, Uniswap. And then we have seeding orders of actually in terms of millions of dollars actually to buy those tokens, right? Then the only options we have is actually to source liquidity bilaterally or Uniswap. Like I mentioned, right? Uniswap's order book is pretty thin, comparable to millions of dollars of order book, right? So for us, for a regular customer, you run into the same situation you had before, like that mentioned in 2017, right? You can move size, and you can now find a trustworthy counterparty to trade with. And that's basically like where we came in. I think on quite the contrary, right? I think efficiency is actually definitely improving in moving the major coins like Meltem just mentioned, like X-Margin and those products. I think it's still working very hard on further improve efficiency to the level of what we had in commodities market, equity market. But on the altcoin side, I think we're still at the early stage of token issuance trading on different exchanges, and the facility and the infrastructure to support more liquidity on that end, I think it's still catching up. I think it's actually up to guys like us sitting in this room actually to start improving it, right? That's basically, I think, where we are today in terms of liquidity profiles between roughly these two major, obviously different regime of tokens.
Mm-hmm.
If I can use an analogy, Ricky, I think what you said is so right. A lot of this is also like the market formalizing and roles becoming clearer. I think historically, you know, the market has been crypto people like trading amongst themselves. I think now we're starting to see different players enter the market. Like you have firms who are actually high frequency trading. You have firms who want to connect via fixed API. Like you didn't have that 3 or 4 years ago, just the level of sophistication and the products and strategies weren't there. Like when I started my career, I traded ethanol and methanol. There were like 8 people I would trade with, right? I sat at a physical desk with a phone, and I knew if I had a cargo in the port of Rotterdam, there were like 8 brokers I would call who would maybe buy that. I think 5 years ago, like I used to talk to Dan at Circle all the time when I was at DCG, right? And I'd be like, Dan, what are you quoting on this? Like Dan was the guy I'd call. He was the only one who was making markets and some of the long tail stuff. And it was really like, he knew who the buyers were, right? And if he had something he knew I might be interested in, he'd be like, oh, okay, I have like 4 maybe buyers for this. It was small. So as the market grows, I think it forces like roles to get more defined and market participants to take on clearer roles. So that I think has also been exciting to see, like Paul Tudor Jones getting in, like he's going to engage in a very specific way, like high frequency trading firms starting to add to their book, hedge fund managers, commodities traders starting to add from their PA or maybe side fund. That also kind of changes the roles people play and starts to formalize things a bit more. So definitely like commodities, that's the analogy we use, right? Like my team, we all come from commodities. In the 90s, nobody was trading commodities. Now, you know, it's huge markets, mostly derivatives, paper trading.
Yes, absolutely, Meltem, you're right? So, you know, back from my commodities days, right? I think when I started trading crypto, I treated everything like crude oil and natural gas, right? It's just supply demand, analyzing of all the different long tail altcoins as a commodity. And back to what Dan mentioned, right? So the ability to take a risk in this market really is actually largely depending on how familiar you are with the market. If you're not actually knowing the market like we used to know, say, the local gas hubs, right? What's the supply, what's the production, what's actually consumption? You know everything, then you're comfortable taking sizable chunk of risk. And you can, after taking a sizable chunk of risk, then when the orders from client side comes in, you can help them, right? It's like when Dan called us, you know, need some, you know, altcoins to shift around, and we do not have inventory, or we do not have the ability to take on risk, then of course we cannot really actually help them out, right? That's basically, I think, the core competencies right now regarding those altcoins trading and spot liquidity. It's the same thing, right? You have to know, you have to be the one that everybody knows that can move sizes and also can take on risk. And that's precisely where we are right now, which is a very interesting market. You feel like you're reliving the history again, right?
Go ahead, Dan.
Sorry, no, I was just gonna say, look, I mean, like, I think this gets a little bit back to like the ethos. Like, if you come from a background where you're like, all right, I believe in sort of all this crypto stuff, like I'm a buyer of like all this stuff in aggregate, your risk tolerance will most likely be higher. And like historically, that's been like a competitive advantage, right? If you're willing to put a lot of this stuff on your books to then leg out of it, if and when like that sort of buyer comes along, that's like a huge advantage historically in this stuff. Now, like, look, like in Burn you can get your face kicked in all of 2018, but like that could have paid itself double in like the last 12, 18 months. So like that's like a big thing I think these days. And also just like hit another point, like when I was on my way out with Circle, like we didn't make any money on Bitcoin, ETH, or Tether. Like those products were scratch, especially after cost, right?
Isn't
like
isn't that still kind of the case?
It should be. I don't think it's gotten any like better, right? Like markets don't get more inefficient like that. So like that was just business we did. So like there's this, not to like jump into the question that was like on the chat, but like there's this whole like theory that like all these like different things are gonna like crush OTC debt. Like OTC desks don't want to like be making Tether dollar markets. They do it because they want the rest of the business, and it's just like a free service that they're doing. So like yes, there may be like super deep liquid like DeFi alternatives, but I'm not like convinced they're better. Like nobody's making money on either of them. So I don't know. That's a little bit of the background of like the evolution of that side of the desk too.
But wait, but Dan, I think there it's important to bring up like the evolution from agency to prop. Like 4 years ago, all of the brokers were doing agency trading, right? Meaning they don't take any risk on their book. They're just matching buyer and seller. Like we're only just now starting to see bigger desks that are trading prop, which I think to your point allows people to take more risk. But like even 2 years ago, right, like people just didn't want stuff on their books. They wanted to only do agency. And I think that's naturally a limiting factor, especially when you have a liquid markets. You need people who are buying and selling in size, like who want to take risk for liquidity to exist. And so it's kind of like a chicken and egg problem. It's recursive, right? Without the crypto market cap being bigger and more people trading it, you don't have bigger desks who are willing to trade props. So it's sort of been a recursive problem.
You mentioned earlier this notion of firms sort of formalizing their roles or having their roles formalized, but at the same time, you know, everybody's trying to get into this prime brokerage game. We talked about this on the podcast, Dan, when you were on a few weeks ago with Bobby. How does that impact liquidity or just impact the market dynamic where you have some of the largest trading firms and trading operations, exchanges, custodians, all trying to basically be the same thing?
Yeah. So I don't think it does yet. I think it's a lot of name only with a lot of participants currently. Like there's a lot of people saying it, but there's not a lot of like actual happening. But like, look, there's a world where like this starts to get a little like confrontational with all the different parties, right? Like you haven't seen anybody cut liquidity off to anybody else yet, but like that could potentially happen. I don't know. I still think crypto in general has got this ethos that we think the whole aggregate thing is going to grow. So like everybody's still happily working together. Like, look, here's like a perfect example. Like I can borrow from Genesis and go trade with Cumberland or like, and nobody like cares yet. Right. But if this thing gets super, super competitive and like the margins come really far down, that's going to be harder to do, I think. Not that they'll ever stop you, but like they're going to try to like keep it more in-house. So it's a problem in the far off future, but for now, I think it's still going to be fine for the foreseeable future. At least that's my take on it.
I disagree with you, actually, Dan. So I actually think once I have, well, here's what's different, right? If I own a particular asset that's thinly traded or is in a broker to broker market, the PDs like limit my set of options in terms of where I can trade. With crypto, once I have a Bitcoin or a token, an asset is an asset is an asset. It's hyper fluid. It doesn't exist in a specific custodian or a specific wallet, right? I can do with it what I want. So I actually think the hyper fluidity of collateral in crypto is going to prevent a lot of that capture, which in my view makes the whole PD model sort of short-sighted. Like longer term, I think, because of this fluidity, people are going to go where the alpha is. People like, that's why DeFi is taken off so quickly. Like all I need to do is go to a desk, buy a shitload of ETH, and then boom, I'm on Uniswap and I can do whatever I want. Like this hyper fluidity that's facilitated by the fact that I can trade 24/7, 365, any venue I want and settle with finality where I want. Like I think that's fundamentally transformative. There are some market players who are trying to replicate the way the old world works. And I think this is a new world. And we need to embrace this hyperfluidity and this ability to trade 24/7, 365, trade with who you want, clear and margin how you want, settle where you want. Like that is super transformational in my view. It's going to completely upend capital markets.
So
that moat is gone.
Yeah. So I think like the one counter to that would be is that I think like the prime brokers, if it ever like, look, let's say like that whole thing like ends up like becoming what everybody thinks it is. Like their hooks are going to be like the margin and leverage aspects of it, right? It's going to be like, I got to post this here so I can trade this. And like, these are like the leverages like I'm getting. And like, that's how I think they're going to try to like keep it sticky in it. Cause like ultimately that's what these guys all want to be doing, right? Like trading's a zero sum game. Like that's not going to be a ton of money for these guys going down the road. They want to be lending to you. And if they're lending to you, they're custodying your assets and then they're holding them. And like, that's how they can keep you inside their wheelhouse. So I don't know. I hope it doesn't go that way though.
That's where it actually gets interesting, right? I think I actually do not necessarily agree with both of you. I mean, either of you, because I think fundamentally, I think the whole idea of primary brokerage in crypto space is actually a misnomer, right? I don't think it actually exists anymore because, you know, back in the exchange days, right? When CME has, you know, say JP Morgan as a prime brokerage, it serves actually two functions. One is actually definitely provide leverage, right, and margin management, everything, and connecting to other smaller execution brokerage firms, right, to route orders to it. While in the meantime, prime brokerage has a huge responsibility, regulatory responsibility, to ensure the credibility of the CME clearinghouse, right?
Sure.
When shit happens, somebody's actually there to cover financially and are obligated and watched by CFTC, SEC every day. That doesn't exist in crypto anymore. Actually, guys like Binance, guys like not Coinbase, but Binance, Huobi, those guys, right? They're like, when they actually get hacked or rumors got hacked, right? Something they cover their own basis. They pay out from their own prop funds, right? And I think the idea of providing leverage is, right, look at all the exchange issued products, like the margin products on all the exchanges, right? To me, that is actually already prime broker there on the exchanges. So that's why I'm saying, like, we got questions like whether people are asking us, like, whether we want to do prime brokerage, right? I'm like, I don't want to compete with the guys who has tens of millions of users on it and can issue products and immediately get access to all. Immediately, those users actually get access to it. So to me, I think the prime brokerage role, right? If you talk about how to formalizing everybody's role in the industry, I think that role has already been filled long time ago, without actually people knowing it. And those are the exchanges guys. And I think they are punching up pretty hard.
But the institutions are coming, Ricky. The institutions are coming.
The anarchists, right? To me, we are the crypto institutions, right? Or you guys all here. I think.
Not me.
No, that's a part. I think it's an interesting argument because I believe everything that actually grows internally from the industry itself. I think if no outsiders like institutions coming in and given a few years, I think those are going to be our prime brokers, and that was pretty much it.
But do firms do the prop firms in this space, or like a CMS, could they benefit from a intermediary who kind of is responsible for linking up to these venues, is doing the due diligence, and then they have that sort of conduit through which you can then trade across various venues, whatchamacallit exchanges that you necessarily wouldn't do the due diligence on, and just make that process simpler? Or is that just baloney? Is that really something that you need?
So I would say it's less about the due diligence, and look, in general, we're very comfortable with the risks, and most people are when they have already made, if you've accepted you're going to trade X and you need to go to these places to do it, you're kind of fine with that. That's generally been our finding. What's annoying is actually hooking into all of them and doing whatever KYC you have to, building whatever tech integration you have to. I don't want to have to hook into 7 exchanges to trade one altcoin that I may trade 500 grand with 2 times in my life. That's not a good balance of resourcing. So what I want is somebody who's done all that infrastructure work that I can just face. And somebody put in the chat, this was to Gomi's thing. And we did use them and have used them for similar sort of ability to hit all of the exchanges at the same time for the lower liquid stuff. So it's really from how much back office and settlement work do I want to be responsible for, and how many developers do I need to keep on staff to manage all this stuff versus something else. It's never been about, look, I've just been in crypto a long time, so my risk tolerance is really high, but it's never been about, I want to make sure that this is all regulated and all these venues are covered, and I'm not less worried about that exposure risk than I am about actual work that it's going to cost my team to be able to interface these things, because it's a pain. And look, if you've ever had to reconcile one of these real long tests, you can't even on OKX go back more than 3 months in the history. That's so much annoyance if you're trying to do audit and accounting and back office stuff. That's really where you're trying to outsource, in my opinion. I think that's the big thing.
That makes sense.
But again, I think it goes back to who's your client. I think a lot of people are talking about PBs from a perspective of institutions. If you're, a multi-trillion-dollar asset manager and you're trying to offer crypto, or you're JP Morgan, your requirements are different. But I feel like people are very unrealistic about the current state of the industry. It is still very much crypto firms trading with crypto firms.
Yes.
There haven't been so many institutions who've come in that going through all these extra steps of getting all these different licenses, checking all these different boxes, et cetera. The juice has not yet been worth the squeeze. I think for a lot of these firms, as the market shifts, they'll go out and they'll get those licenses and go through those certifications. Like we recently went through a whole slew of certifications and upgraded all of our infrastructure so that we could deal with larger institutions with more stringent requirements. We obviously have really strict requirements, constantly updating for our counterparties and who we interact with on the trading side. Look, at the end of the day, like where the money is, where the P&L is, where the clients are, and what people want dictates what firms in the industry do. And right now, like people aren't willing to pay premium for it. So I think for a lot of folks, it's a question of risk versus reward. We've seen a bunch of firms go down this route. Like Bakkt is a great example. They've invested tens of millions of dollars in being regulated. You know, we have a few others who are sort of in that position. Like ErisX is a great example. They spent a ton of money and ton of time getting the compliance right. It's like, does the compliance matter if you don't have customers? Like, I think the better approach is get the customers, prove the market's there, build the business, and then as your clientele evolves and has specific requirements to trade in size, like you match your structure to match what your clients want. You don't create the structure to dictate to your clients how they should trade. So I feel like a lot of people are coming in from Wall Street, like trying to push
you can't take this build it and they will come approach.
No.
Yeah, no, that's never actually how business work, right? It's like you got to actually serve your current existing clients in the industry.
So
right? I completely agree with Meltem.
What do you think? Yeah. What do you think maybe CME got right that some of these other institutional newcomers didn't, right? Because they've been able to build very quickly a liquid market that vies against some of the biggest.
Well,
it's got leverage.
Changes. Yeah.
It's the only cash settled product also. Like everyone else is doing actual physical settlement. If you don't want to touch Bitcoin, but you're happy touching dollars, like great. Mm-hmm. Right.
And it's just a huge existing clientele of CME, right? Then they're just leave a fraction of that actually wants to trade Bitcoin, they go to CME. And that's already big enough for them to ramp up initially. I mean, the launch of the Bitcoin futures contract was probably one of the most successful launch product ever on CME platform for a very specific reason. The customer needs is there, but that customer base is actually a lot different than the customer base of ours and Meltem, right?
But Ricky, I think to this point, like looking at the commodity space, right? When people started trading oil, they started trading physical barrels of oil to hedge production, right? And it was trading in the industry. Oil has now been financialized, and the majority of oil trading is paper trading where there's no delivery, right? And so I think the Bitcoin industry is heading the same way. Like at a certain point, there's certain audiences perfectly content to trade Bitcoin depository receipts or like trade Bitcoin IOUs for these cash settled futures. So I think for a lot of people, they're happy to speculate on Bitcoin. They don't care about like the cypherpunk, like settlement finality, private keys, blah, blah, like they don't care, right? They just want to participate in the speculative price action, and the CME product's perfect way to do that. You don't have to change anything about your existing infrastructure to trade that product. You just need the cash pipe and you already have it. So I think that's the important thing here is like, you got to know what different people want. Like institutions aren't looking to trade physical Bitcoin for the most part. They're perfectly happy with price exposure. Whereas people in the industry like care more about having custody and then like being able to do more complex things with leverage. And that's why I think people are moving to DeFi is like, hey, I want to get leverage. I don't just want to lever once. I want to lever like 10 times and then go into this long tail. Like you got to take some risks.
I think what Dan mentioned right back then, like what is actually currently the crypto traders or crypto industry needs, right, is really the infrastructure side, right? Like Dan mentioned, right, he doesn't want to connect it to 80 different exchanges, but we already done so, right? That's kind of things we do, right? It's like we actually connected probably more than 120 different, we call it liquidity venues. It could be a Uniswap, it could be a balancer pool, it could be a Binance, or it could be some other exchanges or MXC. But the actual ability to reconcile among those, right? When Dan mentioned there, I was smiling because we had went through those headaches, right? Open up a Korean exchanges, open up a localized, Southeast Asia currency exchanges is, its entity to trade them is actually very, very difficult and cause a lot of headache, right?
It's terrible.
When Dan called me up, right, says I want to trade this token, I don't want to tell Dan that I can't do it. I want to tell the customers like, always, yes, we can do it, right? So, but that's kind of the middle back office and trading infrastructure work that we are doing every day. Unfortunately, it doesn't seem like it ever ends because there's new venues coming up every day, including the recent DEX ones. But the ability to do that, and also, I mean, I think the willingness to put down work in the middle back office and also the technology infrastructure, that's actually sort of like important to serve again, right, existing customer base. Yeah.
So
Makes a lot of sense.
I was just going to point out on the CME side. So there's a couple things also on CME's like favor. Like one, it's really cheap. Like it is very cheap to execute on CME. Like so much so that we basically considered it free when we used to use it, and we're pretty early on that thing. The second thing is like unknown to a lot of people is like some of the largest, I would say maybe all of the largest like liquidity providers on the screens currently for Bitcoin on the spot and the future side. They all trade futures too, right? Like a lot of these desks have other businesses in the FX side or in the equity side, and they're already in it. So like it was really easy for those guys to plug in and pump liquidity into it. And it was almost no hurdle from like a compliance and legal side to get through it. So like CME had a lot of favors in front of it. Look, and it worked. Like the one thing probably holding it back is that it just doesn't have as much margin as you get elsewhere. But like that's obviously a regulatory issue for them a little bit more than it is for say these off exchange or these like offshore venues who can just jack it as much as they want. But I think more and more liquidity is going to go there.
Yeah, completely agree. I think they have to prove, like, I did my CME shares work, right? They have to prove the CFTC, the actual deliverable supply of the Bitcoin within the United States, actually as a percentage of a position limit to CFTC. It's kind of hard to define what is actually the deliverable supply of Bitcoin in the United States, right? That's actually pretty difficult to measure. So I think that's where they are stuck right now. How do they actually measure the spot liquidity on I think on US soil, right? That's actually pretty difficult. So they have to go with a conservative approach right now.
Yeah, they need more stuff too. I mean, like it's just Bitcoin. People want to be able to cross collateralize.
Definitely. I want to shift gears a little bit to talk about the thing that's on everyone's mind, which is DeFi. Right. What do we think about the state of liquidity there is, not the same as maybe spot or what we're seeing in derivatives, but it's definitely better than that first wave of non-custodial exchanges. If you look back onto 2017, for instance, the word that I often associated with DEXs back then was paltry volumes, paltry liquidity. And it seems like this new wave has figured that out a little bit more. Curious on your thoughts to why that might be the case.
Well, some of it is just purely because they put a token into it. So like some of these things are as big and as liquid and as deep as they are because it's sort of, I don't exactly know like the word, but like it's propped up a little bit by the fact that like there's issuance of this like third asset into it, right? That like subsidizes the rest of the activity. And like those assets, look, I'm never gonna make like a price projection on where the stuff is, but like they're very rich. So like that keeps like supporting this like excess liquidity that you're sort of seeing in certain aspects of like DeFi. That's not true for everything though. Like that's not, there's a lot of things that operate in like DeFi now that like have nothing to do with that have like sort of caught a secondary bid to like that. But I think like the fundamental core concept is that these tokens have been a way to bootstrap liquidity and have kept a lot of liquidity there. Now, I don't know how that's going to play out longer term as like sort of you get real price discovery on some of these things and where it lands. But for the immediate future, like as long as people want to buy those tokens and justify really high valuations on it, like people are going to keep doing the activity that props up the liquidity that keeps these things being like super big and super hot. Like, I mean, that's like why you saw like the big rush of all the money sort of like come in, or at least that's my vantage point of like what's keeping the whole thing. Like if you're like, what's the core base thing that does it? It's like that little excess that you get from the token side.
Yeah, absolutely right. I think to a little bit more concrete example, right? You should take a curve as one example. I think that's actually at the center of the DeFi world right now. You took a look at like a Y pool, right? The stable coin pool that it provides. I think it's around $800 million there, right? And if you actually going to swap any sort of stable coins there, you actually can get pretty good spreads. It's actually getting very, very close to what actually currently, I would say, the OTC desk can offer. For simple reason why the yields come from a few I would say aspects. One is definitely the curve token, like Dan mentioned, right? That actually provides extra incentives for people to park their asset there. Once you start parking your asset there, it doesn't matter if it's PAX or USDT or a DAI. It's actually a stable coin. It provides a base for liquidity. That is what Meltem mentioned, right? It's like your order book depth right there, right? You solve that problem by providing extra incentives. In the meantime, we look at the numbers of the daily trading volumes of that pool, right? It's actually around like 20 million or something like that. So people are actually using that pool to swap stable coins in and out, in and out. And that swap fee provides another layer of incentives for those, people to actually stake their asset there. And that earns this partially this swap fee, right? It was hoping to actually create this, I would say, benign circle of, of incentivizing assets, more liquidity, and then more incentive to the asset holders. Create that cycle. I think right now we're at the early stage of seeing how exactly that's going to end. But right now, from the look of it, it's working, right? It's actually working pretty well. You have been able to attract tons of capital in a matter of just hours, right? So that's basically, I think, my take on that.
Do you think that a token in either DeFi or spot exchanges is an effective way to build liquidity, or is it kind of just is it a must-have, a need-to-have, or a kind of nice-to-have?
I think it's actually a must-have as well, right? Take a look at the current, I would say, the major DeFi projects and players, right? You have Wi-Fi, right, which is basically an index fund manager on top of the entire DeFi world, and you have Curve, Balancer. This, I call it liquidity providers, right? You have Compound, ARP, those lenders, right? If you check, all of those different players, they have one thing in common, is that their own token is listed in the centralized exchanges, actually have a lot of liquidity. Trading volumes for Curve. Metal? Yeah, go ahead.
Okay, but the token, in most cases, the only reason it exists and the only reason you see liquidity in it, like what Compound got right, like the governance of Compound and the governance aspect of Curve, like kind of a joke, right? Like there is really no decentralized governance. It's a very inside group of people. Maybe that gets distributed over time, but like I don't think the point is governance anyway. What Compound did really well, what all these tokens do really well, is their native token can then be leveraged as collateral on other protocols. So what you're doing is the same thing that ICOs did. You create artificial scarcity, exactly, and you create a funnel, a vortex of money, or I think Thorchain calls it the liquidity black hole. You give people a token, they take that token, they lock it up other places to get more leverage. Then retail comes in. There's all these trader groups where people are hyping their trade. People are trying to buy this stuff on exchange. The liquidity is super low, so the price pumps really high. Like the reason Yuffie's trading at 13,000, yeah, it's dope. Like it's a dope product. But the reason it's trading so high is because the supply of Yuffie is artificially scarce. It's limited to 30,000 tokens. That then drives a sort of scarcity narrative. So there's a fundamental link between retail demand and this cycle of liquidity where people are trying to play these games. If I can get someone to farm my token, take it and lock it up in another protocol, and then create hype where OTC and players who don't know how to yield farm want to buy the token, it's a perfect, and so I think a lot of people have perfected the game. We're now seeing vesting in liquidity mining, right? Like a lot of these pools are now doing 12-month vesting where you have to keep your liquidity in the pool for a long time. You don't get the tokens for a long time. So I think this is all going to get gamified. Like in my view, there's nothing new under the sun. This is just a way of extending leverage into the system. And then I think the fact that Nexus Mutual, right? Like I wanted to buy cover for DeFi position the other day. Nexus Mutual requires me to do KYC, AML, and like go through a whole onboarding flow. Like to me, that defeats the purpose. If I have to do that, then I might as well just go through a desk, So in my view, the world of DeFi and CeFi are actually not very far apart. It's just figuring out the different mechanics and finding where they meet in the middle. But it's the same sort of game, just played two different ways. But at the end of the day, it's all about like, I want to get leverage. If I'm fundamentally long Bitcoin, like I'm not just going to sit here and hold my Bitcoin. If I can earn 50%, 100%, 150% in 3, 6, 12 months, like if I'm comfortable with the risk, I'm going to do it. And these are people who are already comfortable putting their coins in like Celsius or BlockFi or wherever they're putting them. Like for them, punting them into like wrap BTC and then throwing them into some protocol to yield farm, they're like, great, right? This is about leverage and making money. And I think, Dan, like perfect segue to you. It's like, do you want to be right or do you want to make money? Do you want to make money? Like that's it.
Well, it kind of goes back to the question that Dan addressed earlier on, is there a possibility or an environment in which the sort of DeFi world eats the lunch of the CeFi OTC desks? And Meltem, I feel like you're kind of the same opinion. understand that it's no, but maybe they sort of blend together in this way that you're describing.
Yeah, I mean, look, so I mean, I would say that like bilateral trading desks are users of this stuff. Like, it's not like they're gonna, as much as they can be, there's like different compliance like concerns with like that relationship that are gonna like, I don't know where that's all gonna shake out, but like, let's just suspend disbelief for here for a bit. But if all the liquidity is there, they're not gonna not use it. And like,
Yeah,
a lot of what like OTC and bilateral trading desks are like selling is like convenience and speed, and like they don't want to go figure out like, how do I wrap it and put it here and then send it? Like, it's like, can you just quote the whole thing all in and I'm willing to pay you to do that? Like, that makes a lot of sense for a lot of counterparties, and I don't think that's going away ever. I mean, there's still block trading OTC just for equities, and like, we've been trading electronically for 40 years now. Like, I don't think that's, this idea that you're just going to kill off that whole segment like entirely, I think is a little overplayed.
Mm-hmm. I think it's
oh, sorry, go ahead, Ricky. You got it.
Right. So I think it's actually depends on a little bit of like what you want to trade, right? So like I agree with Dan. It's like most of the cases, right? People go to OTC desks like us. It's not because liquidity issues or slippage issues. Actually, a lot of times it's just they want access to liquidity. The easy access to liquidity, that's actually more important to them, and also the long-standing relationship between different trading counterparties, right? The trust that have been building, over the short life of crypto world, right? is still very, very valuable. But in the meantime, us like OTC trading desk is not like a DEX is seriously competing in most of the aspects. It's actually more like us. When we actually go to DEX, we're normally actually a liquidity taker, right? We're taking liquidity out of them to serve our clients, right? We're not, to be very honest, at the time, we have not really been a pure liquidity provider in the DEX world yet. Just because right now is actually still the early stage, we're moving into that direction to be a provider, liquidity provider. But right now, to serve our customers, we're actually pretty much 99% takers of liquidity, which doesn't really put us into the competition against the DEXs. But there are a few exceptions, like stablecoins. I think the stablecoins volume dropped in the OTC desk recently. I think I speak for all of them. Because very easy, right? Like, you go to Curve, you go to other stuff, you can actually do a very sizable trades with just like a 20 basis point slippage, which is also already pretty good. We don't have to do those KYCs and then settlements, everything. And all you need is just another stable coin. Then really, I don't see any other reason why you do not actually go to the Y Curve, S pool,
to Dan's point, yeah. The desks aren't necessarily going to miss that flow.
But I think one important thing that Ricky said, and I think people were talking about in the comments, look, like a lot of people, again, get really hung up on the regulatory stuff, right? It's like the same, like now we're seeing all of this like fear mongering around like, oh, DeFi is going to get hit with a ban hammer by regulators. Like, okay, good luck banning like an exchange, in the social, like, good luck with that. I think at the end of the day, like what markets have always been about is money. Like, if there's a way for people to make money, they will find a path and a way to normalize it and do it. Look at the crypto credit market, right? It started with just a few desks who would offer leverage. Now people have figured out a pathway to do it with an illegal wrapper, regulatory wrapper in the US that makes it permissible. And every desk is offering it. Every firm that has clients is offering like at least agency, if not prop sort of lending. So I think, again, like if the money's there, if the appetite is there, and if there are customers, I would worry less about like, do we have the right regulatory wrapper? What we always think about at CoinShare is like, okay, what do people want? Let's start with what people want, and then we'll figure out how to wrap it up and package it and make it accessible later on. But you first have to have, the loyal following and people doing volume. And DeFi, like, people are doing volume. People want this. So in my view, like, there's sort of that's the call to action. Like JP Morgan's 100%. The minute that they have, huge clients saying, I need Bitcoin, they're going to figure out a way to do it. The minute it becomes a multi-billion-dollar opportunity for them to offer commercial banking custody, they're going to do it. Like, they're not stupid. And that's the thing. If crypto gets big enough, if all this stuff gets big enough and there's money in it, people are going to do it because they're in the business of offering financial services to their clients and making money in that process. So if there's money in it, people are going to do it. And so I think all of the like regulatory issues aside, people are going to find a way to do it. There are a ton of super smart, super motivated, super creative people in this industry who've solved tons of really thorny problems in new ways. So my confidence is like, we're gonna figure it out. Let's just build what people want. And they want it. They want leverage. Like, hell yeah, leverage is the best drug in the world. So give me more.
Inject it into my veins. I think one other interesting trend, going back to sort of the CeFi world, is this growing momentum on the retail side, right? You're going to have PayPal possibly come online with, I think, a multi-coin service. You have, you look at Cash App, that's growing at a fast clip. And then obviously the news yesterday with FTX acquiring Blockfolio, they're going to make a push into retail trading. How does that impact the state of liquidity for this market in your view, Dan?
So I don't think it's going to change the liquidity a ton. I think I guess I'll take one first stab at saying that, like, I think this has always been a retail market, and like maybe just now you could like make an argument that Bitcoin is starting to see some like institutional participation, but like for the most part, it's still very, very large, driven by like retail. That's just the market. Like that is what it is. And it's also primarily retail in Asia. Like this idea that like the US is the trading of this thing is like wrong. Like I just don't buy that at all. Like look at the biggest exchanges, they're OKX and Huobi. And like people here are just massively dismissive of them. But anyway, that's like a whole other point. So like in terms of what I think the retail participation is going to change on the liquidity front, if anything, it's just going to be, if you have a huge retail base that wants to like mash buttons and trade, like the professional market makers and liquidity providers are going to give that to them, right? Like this was always a conversation I remember having at Polo where it was like everybody was very concerned about getting like the liquidity providers and like the big traders on there. And I'm like, look, that doesn't really matter. Like those guys are just going to go to wherever the end taking order flow is, the people that like want to like take that risk. So like if you have a massive push of retail order flow through, like the big liquidity desks are going to find it. Like, a lot of them already have, right? Like that's why you see like the jumps in the HRTs and the XTXs of the world like trading on these venues, is because they know there's a ton of like uninformed order flow that's like pushing through at any given time. And that's the business of what they're harvesting, like to use a farming analogy, because I guess that's what we do now. But like that's, so I think, look, if you do have a lot of push in the retail side, it's going to be good for liquidity in the sense that like more people will take notice and more people will try to trade it. That's, I think, the cycle that you see there.
Mm-hmm. What do you think, Ricky?
Yeah, I mean, there's really not much to say here. I think that's definitely a good thing. I sincerely hope they all succeed, right? When they actually, the flow is coming in, OTC desks, liquidity providers, us and CoinShares, everybody will benefit from it. What we call those are actually good flows, right? Institutional side, institutional trading side, whatever flows we actually start to get, at least the in a statistically proven way that order flows are not good, right? When we actually start doing it, we have a short-term view of the market, and then those are going to be most likely categorized toxic flows, right? But the retail side, that's definitely good flows, and for us to help them to provide the liquidity, then that risk premium is actually already factored into whatever price we provide on any other institutional trading desk provides, right?
Mm-hmm. That makes sense. I guess we're getting towards the end of the conversation. I guess like looking towards the end of this year, what are maybe some of your most controversial takes, maybe about trading or liquidity, that you are harboring within?
I think, like I mentioned in the prep call, right? So I think people are actually too fixated on this whole DeFi and yield farming thing. And I think the not really looking at the overall big picture. I think the overall big picture is actually the whole DAO governance thing, right? It's actually, I think recently we've seen more. I've seen like a DAO investment, like allow those kind of foundations, like purely transforming the way investment works, right? Instead of actually forming a hedge fund, forming a venture fund, you can join the DAO and share the deal flows, right? And the trading side as well, right? You can actually just go ahead and using 1inch, right, in a completely decentralized way to execute the orders as brokerage firms. And there are other areas, like one interesting project I mentioned as well is actually called bounce finance, right? What I mean is that it's actually a distributed it's a distributed version of CoinList that actually allows people to launch projects, raise funds on top of it, and the government completely bows out, right? For me, it's like the whole DAO transformation from more centralized way into a decentralized manner. I think that trend is actually bigger than the current, yield farming or all the different DeFi or different fruit basket of yield farming concepts they come up with, right? I think that's basically what I'm looking at. So I'm very much hoping to see in the second half of the year. I mean, in the remaining part of the year, that message probably is gonna become more clear. That this thing is actually bigger than right now, than purely like Meltem mentioned, is like adding up air leverage, chasing the yields. I think something transformational is actually happening. It's just not that obvious right now. And I want to see those new projects on the other swimming lanes instead of just yield farming side actually start come up more. And that's where I think we are also putting some investments and also try to work with those guys as well. Yeah.
Yeah, I think on the macro side, I'll let Dan have the last word because he always has this spicy take. And look, I think there are two things I'm looking at. Like, one is stable coins, right? So I definitely do think if we look at velocity of Tether, if we look at velocity of USDC, as a result of what's going on in the yield farming space, the velocity of these coins gone down a lot, and it's shifted over to some of these DeFi tokens that are being used as collateral for leverage. So I think it's been interesting just to like look at overall velocity in the stablecoin space. However, like, in the last 2 weeks alone, close to $2 billion of new tethers got minted. I think we're going to see, with the acceleration of the DCP in China, with the acceleration of other stablecoin projects, I definitely think that the macro environment is prompting a lot of people to examine where they want their assets to be. And I actually think the most important thing that crypto and DeFi and all of this is showing the rest of the world, which I'm super excited about, is like the correspondent banking system. There is no fundamental reason for it to continue to exist. And that's where I actually talked to a lot of fintech VCs, and they're like, oh, well, crypto's like a side thing. Crypto's not fintech. I'm like, crypto's going to eat fintech. If I can build products and services that allow people to access checking, savings, investing, all of these different things that we're accustomed to doing through a financial institution, but do it in a more efficient, cheaper, faster way and have fun and dank memes while doing it, like, we're going to do that. And I think people underestimate the dislocation that will happen. Like, we have a generation of people who are sitting at home, like, glued to their screens. They don't have shit to do. They're all trading. They're on Robinhood. They're on crypto platforms. Like, over the next 2 to 5 years, I think it will start to become much clearer, particularly in emerging markets that have historically been dollar dependent, but can't get access to the Fed printer. Like, they can't get SDRs right now, right? Like, the US has had a stranglehold on global economic flows. People are de-dollarizing, but I can still be dollarized and just use a synthetic dollar, i.e. stablecoin or some sort of representation. And I think this is going to be so transformative. Already, capital markets, like, we've figured out I don't need traders on a desk sitting in an office to trade. Like, people are fine trading at home. So I think this whole shift that's happening is starting in these small places, but that snowball's growing. And I think ultimately where you get to is like, you start to recognize, wait a minute, 24/7, 365, financial access, a global market, one unified market with a variety of assets. Like, that is the vision for the future. That's what I've been working towards for the last 6 years, first at DCG, now at CoinShare. Is like, we've got another decade, 2 decades to go. It's going to happen. It's not a question of if, but a question of when. And I'm going to push my fucking hardest to make it happen as soon as possible because it's going to be fire. I'm pumped.
I do wish that I unfortunately do think the opposite, where you're going to see like a 24/7, 365 market for everything. And I do wish crypto would go the other way, but that's just, you can't do that apparently. Because 7 years of trading this thing 24/7 it gets fucking old. But to piggyback, so like, what do I see happening? So I think there's a couple things. Some of these may not be great. Some of these may be. Stablecoins are going to keep growing. There's absolutely no chance that slows down. But there's a number where like the total issuance on stablecoins like becomes a problem, and it becomes a problem because you become a target in the sense that like it's small enough currently where like it's not under massive regulatory constraint. But that question's going to come up, and it's going to be like a lot bigger of a question. And I mean this in the sense that like Congress is going to have to address this. Like, this is not something they're going to be able to avoid if there's $500 billion of stablecoins issued. Now, like, where's that number? Is it 50 billion? Is it 100 billion? Is it 250 billion? Like, I don't know, but like it's approaching it quicker than it was historically. So I think that's on like the back burner, and like nobody ever like really addresses this. I know the folks at the stablecoin projects both definitely think about this a lot. but that's going to rear its head at some point. In terms of like the assets, I think all of the DeFi stuff's great. I think all the current iterations of it are mediocre. I think there's like a lot. These things are slow, they're expensive, and like half the time I don't even know what the execution is on it. I think I like wrote up a thread about this once where like the current experience is pretty terrible. And I think that's going to get fixed because the big thing we're seeing is there's insatiable appetite to use these things, and they're going to build the product suite to get there. Now, whether or not that sits on ETH is like the real big question of all this. I don't plan to know it from like a technical side at any capacity, but there's a lot of people like taking real stabs at this thing. In terms of the token issuance that's out there currently, I think the majors are lagging and all of the like tokens are like way ahead of their skis. So I think what you're going to see is like a reversal, right? Like all these high flyers, like the liquidity and like is going to suck back to like Bitcoin and ETH. Like I think that consolidation has to happen at some point. Doesn't mean you're not going to still see like a bunch of like crazy things, but like that money that enters the system to like go on those crazy things has a tendency to like move back towards like the core projects, like over like a time frame. And I think you've seen like that rubber band effect like not really play out yet. So that would be like my end of year sort of like tail hypothesis on this whole thing. Like, because in no world can you like tell me that like the major things that are the components that make up DeFi like are fundamentally less valuable in a ratio basis than like the products built on top of it. Like I'm just not a buyer of that like whole thesis. So I don't know. Well, those are my like
Chainlink to 100. Like, what do you think, Dan? Chainlink to 100?
Oh, I have no idea where any of this stuff's gonna land. Like, it's just such in like la la land, a lot of it, where I'm just like, because like we get this on the time all the desk, and people are like, "Is it cheap at 10?" I was like, I don't know. Like, was it cheap at 20? Like, these things become very divorced from like any thesis, and you can't just sit around being like, "It's undervalued, it's overvalued," because like you're wrong. You're trying to play on like, you're playing on short term like movements of like a very fickle base that's like jacked up on leverage. Like, it's just like, that's not a great game to play if you're like trying to pump that. I mean, you can do it. And if you see like real dislocations, like sure, give it a flyer, but I wouldn't be sitting there like trying to talk a book on it. I don't know. That's my thought on like where I see the stuff going for the year. We'll see where it goes.
So let's buy ETH, right?
We
Instead
shall
of buy
see.
Chainlink.
Yeah, that's what it sounds like. Buy ETH.
Yeah, pair
Bitcoin.
trade. Just don't get liquidated.
Yeah.
Well, when we'll have to have you all back on in 6 months to see if Dan was right.
See, Dan, that's what you're not supposed to do. Price prediction in a webinar.
It's not a prediction. It's a relative value prediction, and I'll be able to twist it to make it look like I was right.
We'll see what happens. All right, ladies and gentlemen, thank you so much for tuning in. Well, apparently they can't wait 6 months, but we'll have them on before 6 months, and we'll see if Dan was right and if he can contort himself to make him sound right, even if he wasn't. Ladies and gentlemen, thank you. Thanks to the panelists. Thanks for everybody for listening. Talk to you soon.
Thanks, Frank. Thanks,
Thank
guys.
you, Frank.
Thanks.